All right, so we're going to do a real quick review of macro unit 4. This is all of the monetary policy stuff. And then our next review is going to be looking at how that actually works. So bear with me. I want to start with some basics, just some vocabulary. We talked a little bit about risk. That's why we pay interest. When you're borrowing, you're going to pay interest to go ahead and make up for that risk. That money is going to lose value over time. So very quickly, we're going to be talking about investing. I know he's saying don't use the word investment, but basically there's some risks involved when you put money out, whether you're lending it to someone, stocks, bonds, etc. And so what we're going to do is we're going to talk a little bit about how that looks. The more liquid your money is, the more easily you can get at it, the lower the value of lending it to someone else. So if I go to the bank and I put money in the bank, I can get it out the next day. I'm not going to be able to get a high interest rate. So the ones down at the bottom, those are going to be a low liquidity, and you're not going to have a high interest rates. The ones up at the top, so stocks, mutual funds, index, the potential for higher returns is there, also an entire increasing risk, and the money is less liquid. Basically, it means you can't get it back. So when you put money in stocks, you have to sell it. You might not get all your money back. These are not guaranteed funds. These are guaranteed funds, and so again, that liquidity and the risk means you get a higher interest rate the less liquid it is and the increasing risk you have. We talked a little bit about bonds and stocks. Remember that bonds are loans. You owe the money no matter what. Stocks, you have an ownership share. That means you can get money back or maybe not, depending on the interest and the risk involved. So one of the things we start looking at the stock market going up and down with the middle of the coronavirus issue is whether or not those ownership shares, those stocks are going to have any value. As they go up, obviously you can make money on them. You can sell the share for more money. If it goes down, you're going to have less value in each share, but if you're still investing, you can buy more shares. So it goes both ways. I want to remind you, when the Federal Reserve Board issues bonds, interest rate don't change through the life of the loan, which is why interest rates and bond prices have this inverse relationship. So if I've listed my interest at a certain rate, I'm going to get that amount guaranteed. But if interest rates fall and the new interest bonds are being issued at a lower rate, people would rather have the higher rate. I had a couple of people, and I'm hoping they're actually on today, I had a couple of people that did a great job talking about the ability, the supply of them. So that's going to be it as well. The higher the supply, the lower the price, and the lower the supply, the higher the price. But again, it's this interest rate that's going to matter. If you're getting a higher interest rate on a new bond, they're going to want the new bond. And so as the bond prices, the interest rates would go up, the bond prices would go down. People don't want that. But as the interest rates are going up, and again, this is not the interest rate of the bond itself, this is the interest rate of what's being paid out. So I'm going to see if I can come back to this again next week, but this inverse relationship, I really doubt they're going to put this on the AP test, because it's one I know a lot of people have trouble with. They don't normally go quite that bad, but I do want to cover that again. I know ACDC has a great video on it. You're welcome to look at that. We're going to go ahead and move past to fractional reserve banking. We're not going to watch this video, but I just want to remind you that banks are holding a portion of the deposit. So we did the money multiplier, the banks loan it out, they put more in, they loan it out, they put more in, and the multiplier is 1 over the RR. Remember, savings goes on the bottom. When we're doing a bank balance sheet, and they may ask you to do this, remember we have demand deposits, that's the money that people put in, required reserves, it's the amount the bank is required to hold on to, excess reserves, any amount the bank can loan out, it's what's over and above the required reserves. But remember, any money they have in excess reserves is not earning them money, so banks don't tend to leave money in excess reserves. And then we have the balance sheet and the demand. So this is the example that we've had before. You got total assets, total liabilities. Remember, they have to equal out. The owner's equity, remember, that's just simply the amount of money the owners had to put in. So we don't have to hold on to money with this. Here's our $5,000. If there's a 10% reserve requirement, they have to hold $500. They can put out $8,000. They've got $1,500 in bonds. Notice they're earning money on their loans and their treasury bonds, which is what they're supposed to be doing. They're supposed to be earning their money. This reserve requirement, Jeffrey had a great question, because the Federal Reserve Board just put the required reserves to 0%, meaning meaning that banks do not have to hold any right here. But I'm going to point out, in the middle of this panic that we've got with the coronavirus, it actually makes sense. Now banks are going to keep some in excess reserves. They're not going to loan it out, but by requiring them to hold zero in this reserve column, they will automatically still have some. Remember, we talked about that with the 2008. They're not going to loan it all out. They want to have protection, and they're still going to have some left here that doesn't belong to the Federal Reserve Board, and the Federal Reserve Board's not requiring it. Hopefully that they're going to loan out more and keep the economy moving. That's the goal. Reality, it's not going to be an infinity amount of money, because banks are not going to loan out all of their money, especially in an era like this where we've got so much chaos happening. All right, so when the Federal Reserve Board wants to increase the money supply, remember we talk about them with the buying bonds and the discount rate and the interest rate and all of that. When they want to increase the money supply, they're doing that because they want to lower the interest rate. Remember, they're trying to have an effect on aggregate demand. So here's our transmission down at the bottom. If they increase the money supply, remember the supply of money instantly gives you this interest rate fall because there's a surplus of money. The interest and the money supply, the decrease in the interest rate. We're going to talk about this investment, but again, this is business investing, that I in the AD. And so when businesses can afford to invest, that's the idea anyway, and then it will increase aggregate demand. This is actually why the current Federal Reserve Board has put it at 0%. They've moved money over to here with the effort to try to pull this together and increase aggregate demand. It's not necessarily going to work, but that is the goal. Obviously, decreasing the money supply is going to have the opposite effect. We're going to have a temporary shortage of money. Interest rate will go up, which should decrease investing and decrease aggregate demand. And just a quick reminder that you've got the reserve requirements, the discount rate, and the open market operations as shifters of the money supply. Jerome Powell, current head of the Fed, but I will say, if you want to hear a great interview, the AP board had Janet Yellen on, and you are welcome to go look that up and watch it. It was a really good interview. All right, here we go. Reserve requirement, obviously if they're trying to fix a recession like what we have right now, they're going to go ahead and lower the reserve requirement. That's exactly what we've seen. That's the fraction the banks must hold on to. If they're trying to fix inflation, they're going to increase the reserve requirement. So again, this is the goal of these two. We've covered it. I don't think we need to spend a ton of time on it, but just reminding. Discount rate, this is the rate the feds charge commercial banks. Remember, it's kind of like going to mom and dad for a loan, and they are going to raise the interest rate, raise the discount rate to go ahead and decrease the money supply. It raises the interest, and it makes it harder for the Fed to pay money back. This is decreasing the discount rate, increases the money supply because the Fed allows them to loan out more money, and it's cheaper to borrow it. So last one, buying bonds, selling bonds. We've talked about this. These are where that interest rate and bond prices come together. The whole idea that if you want to put money, remember I had you draw pictures. If you want to put money in the system, the Fed should buy government securities. If the people are over here and they have the bonds, the Fed says, here, I will buy your bonds and let me give you money, right? Putting money in the hands of the people to be able to move that back in. So again, I recommend pictures when you're working with this. Federal funds rate, oftentimes the trick question on the AP test, they could still use it again here. Remember, that is the rate that banks charge each other. The Federal Reserve Board does not have control over this, but I'm going to point out they still influence it. They set the target rate, these open market operations to try to make the interest rates fluctuate. That's exactly what they're doing, and therefore other banks are going to change their interest rate based on what the Federal Reserve Board is doing. We've practiced this. You've got 3 different pieces, but I'm reminding you this graph, this investment graph, is not one of the ones you have to know. But you have to understand how this affects this, affects this. So in this interest, we have increased the supply of money that caused the interest rate to go down. Here we see the interest rate went down, which means more people want to invest. That's the demand for investing. And the minute there's more investors, you have the I in the C plus I plus G plus AD. The I shifts the aggregate demand over, causing an increase. Now notice it's also causing an increase in price level. The idea here is that with increase in productivity, this is where that whole Keynesian thing of the weird kinked curve, but we do still see some changes in price level here as well. And again, this is the opposite. All right, one of the big ticket items on the Federal Reserve Board comes to do with whether it's money or not money, money or not money. Checkable deposits are money supply. It's already in circulation. It's already existing. When someone takes money from their hand and puts it in here, that's just simply moving this way. Bank reserves are still part of the monetary base. So I'm going to point out this isn't being moved, it's in the banks, but this right here means that when it's moving in here, it's not changing. Okay? They talk about putting money in, putting money out. It's still checkable deposits, and the money supply is not going anywhere until the money is loaned out. When it's loaned out, it's not in the money supply again. Central banks are going to go ahead and change the money supply by changing the monetary base, how much money the banks have in their base right here. So when they're buying bonds, they have the money, they put the money into the bank reserves, because a lot of banks use bonds to hold on to their reserves. There's more money in the bank reserves, they can loan more money out and put more money into the money supply. All right. Loanable funds, very quickly, this is the last graph, but you do need to know how it's connected. One of the hardest parts here is this part. This is one of the ones that we had issues with, so I would actually recommend that you stop the video and go back over it, maybe as a group. Why is the supply listed as lenders and savers? Why is demand listed as borrowers and investors? And keep in mind, how does the money get into supply? Remember, it's not banks, right? This is where the people are putting money in the banks, but it's not that the banks have it, but it comes from the people. So real quickly, this is going to be real interest rate. I don't know that they're going to ask a question on that, but remember that we talked about the fact that as people who are borrowing and people who are saving, we understand the whole idea of inflation versus interest rates. I mean, interest rates can be dropping like great, but if we know that that's because there's no inflation and that the economy is tanking, well, that means we have the real information. So keep that in mind. Savings supply comes from private savings and public savings and national savings. Remember, this is the amount, by the way, the government saves instead of spends, right? But we've talked about this, right? This is where money comes from. This is where they get the money to go ahead and put into this loanable funds market. So if the government decreases deficit spending, more people are saving, and we have the supply the public savings supply of loanable funds. We're going to have loanable funds falling if they're increasing deficit spending because they're not saving the money that they should be saving. By the way, it could also cause an increase in demand, which is a bad thing. If they change the tax layup and give people more money, tax credit on putting money in a savings account, it'll increase the savings moving it this way. And notice that's going to be an impact here on this interest rate as well. So keep that in mind. Interest rate is going to affect both the demand and the supply of that loanable funds. This one's a big one. This is that capital inflow, capital outflow, and net capital flow. I don't know whether they're going to be able to put that on the 2020 test, simply because that technically is part of that international finance, but just on the outside chance, foreigners are always lending money to the U.S. This is a big deal, especially with our interest rates going up, so they could still use this. So capital inflow, that means the money's coming in. If we have a higher interest rate, they're going to want to put money in here. Capital outflow, that's the money leaving. If all of a sudden China starts offering higher interest rates, we're going to put our money into China. And just like with our imports and exports, that's going to be the net capital inflow. Private investing, government borrowing are obviously going to have an effect on whether or not we are doing the borrowing of loanable funds, the demand, how many businesses want to borrow, is it a good economy or bad? And then right now, I mean, this deficit spending, the government spending is greater than the tax revenue, and you know that's happening right now. Technically, I'd be worried about crowding out, but you'd have to have someone in there to be crowding out, and businesses are struggling to hang on. So in this particular instance, you guys can see real world example of why crowding out isn't necessarily a thing. Right now, obviously, the government is spending money, but there's no one in the private investment that they're really pushing out. Instead, everybody's kind of hunkering down, so the government is the only one spending. All right, that was real quick. We did it in less than 15 minutes. I'm asking you to go ahead, go back over with your people, with your group, and see if there's anything you need to know. Send me questions on Remind. Let me know what I need to tell you. Good luck.